Good morning, everyone. This is Daily Trading Analysis with the weekly recap for this week that has started August and which has been quite a big sell-off again as continuation with recession fears, with lower expectations in earnings, with really pretty bad numbers for the future of the market. Because the stock sell-off accelerated, the bond yields failed, because the NFP report, the job report, was pretty weak, and that fueled the concerns that the Federal Reserve decisions to keep interest rates at a two-decade high risk a deeper economic slowdown. So these fears were not only in the US markets, were all around the world, causing a massive increase in volatility and a flight away from the riskier parts of the market. The S&P 500 experienced its worst two-day slide since March 2023. A drop in the key companies on the Nasdaq also fell 10% from its peak. We are at around 12% from all-time highs, meeting the definition of correction, but still a huge correction. Treasuries also rallied for 7th day in a row, with traders expecting that the Fed is going to cut pretty aggressively interest rates. And basically all this fear is driven by bets on a soft economic landing, but some of those fears are based in the last NFP saying that there will be no more soft landing. There will be a hard landing because the economy is slowing down too much with a pace that is too aggressive. That's why behemoths such as Citigroup, JP Morgan are now calling for a more aggressive Fed action. Goldsby, the Fed president from Chicago, told Bloomberg that the officials will not overreact to any single piece of data, not even the Friday's NFP. They are not going to pretty aggressively correct their path with only one data. And I think that's pretty good response to all these fears that are saying that the Fed is late on their actions, that the Fed was wrong not cutting interest rates this week. Barkin, also the Fed Barkin, said that big rate cuts like 50 or 75 basis points are more typical if the economy is rapidly weakening. And they think that this is not what we are seeing. I agree with that. But the market still freaked out on Friday with all this economic data that was basically a Goldilocks of data pointing to pretty aggressive cooling down of the economy. Let's go to review this economic data. Monday, nothing interesting. Tuesday, JOLTS job openings are showing that openings are still being maintained, more or less. Consumer confidence was strong with 100 reading. And on Wednesday, we got the 30-year mortgage still at 6.82, but applications are not coming through. I think all these people are still waiting that interest rates drop. Basically, this number, I think, needs to be 6.5 or below for applications and refinance to really skyrocket. The first number of employment, ADP employment change, was out, 122,000, freaking out a little bit of the market, and we're starting to see that pressure on the labor market. And finally, the Fed interest rate decision and the press conference. All these statements are in my Thursday's video that I'm going to link right now in the upper right corner. So if you want to have a pretty detailed summary of what the Fed, what Powell said during the press conference, go check that out. And finally, Thursday, we started to see things like this. Initial jobless claims way higher than expected. Continuing jobless claims higher than expected. Non-farm productivity preliminary at 2.3, pretty good. and labor cost going down. So this is good. This is all in the right direction for the Fed. But then when we see all this data with manufacturing PMI below 50 in contraction, ISM manufacturing PMI 46, expecting 48, below 50 in contraction, employment 43, we were expecting 49, below 50 in contraction. We have construction spending in the negative. We have new orders at 47. We were expecting 49. Still, all these below 50. Below 50. Pretty in a pretty aggressive contraction situation. And prices still higher. That's the only thing. We are still in an environment in which prices are higher, but the manufacturing, employment, the orders, jobless, labor market, these are all cooling down pretty aggressive. And the final nail in the coffin, non-farm payrolls 114, we were expecting 175. That was one big hit. And the second hit for a knockout was the unemployment rate raising from 4.1 expected, same as the previous one, to 4.3. Earnings 0.2, less than expected. Year over year 3.6, less than expected. And I mean, this is what killed the market. We were already suspecting that something was cooling down. This data was showing something important, but then the NFP and the unemployment rate really killed the situation. We are going to see how the aggressive sellers position themselves for this and how the key levels were just going out one after another, like a knife through butter. But first, before moving into technical analysis, I would like to quickly review the earnings, because earnings are also a very important part of the markets right now on this week, because we got Meta, ARM, and Qualcomm reporting pretty decent earnings. But on Thursday, Amazon, Apple, Intel, Apple was pretty decent, okay earnings, but Amazon and Intel were disappointing. Basically, Apple's sales rise 5%, topping estimates, because basically iPad revenue was really above expectations. Mac revenue was here and there. iPhone revenue was pretty good. Services. But the thing is that Apple shareholders, Apple fans are still waiting for that Apple Intelligence, because they are marketing out something that they don't have even yet released. So a little bit of concerns, but Apple is still pretty strong. I think Apple could carry some parts of the market. If we see in this graph in a pretty summarized way, we can see that wearables, home accessories, and iPhones were a little bit down year over year, but iPad 24% and services 14%. It's quite good. They have a lot of money. Net income and operating income are still going higher, and during the quarter, we were excited to announce incredible updates on Absolute platform and Apple Intelligence. But this is the key, that no one is really experiencing this AI yet. They did a good campaign on marketing for that, but every other stock company that is into AI big time are already released something. Apple is quite late, I would say. Amazon, disappointing guidance for the third quarter. Disappointment is what Amazon is releasing, because basically earnings were good, but revenue was low due to advertising. On the Amazon Web Services are still there, are still growing, but at a lower pace than their peers. We can see how Amazon's advertising business grew 20% in the second quarter. And in terms of cloud, it reported 19% revenue growth, topping estimates, yes. But where are the others? Where are Microsoft with Azure? Where Microsoft is not at 19%, it's at 29%. And we have also Google reporting 29%. So in terms of cloud, Amazon is strong, but it's not as stronger as other businesses, as other companies. And it's the same thing that happened to Apple. Apple, it's way back. It is quite late in terms of AI in comparison with other companies. Amazon, it's quite strong still in Amazon Web Services in North America and international revenues. They have a lot of income, and they will be continuing making progress and accelerating the AWS growth. That's the key for future updates. Intel was one of the things that helped destroying the market on Friday. Intel is going to cut 15% of the workforce, trying to cut 10 billion cost reduction as part of the cost reduction plan. 10 billion and 50% of its employees. Pretty aggressive. Why? Because look at these pretty bad earnings. 2 cents instead of the 10 cents on EPS, and revenue also getting behind. Revenue declined 1% year over year, and the company swung to a 1.61 billion net loss. Unfucking believable. So Intel is not able to jump on all these other companies, AMD, Qualcomm, which also produce chips, and they are way ahead of Intel. Intel is getting behind. Intel is getting late. And when we are in a career to produce chips for a new technology as it's AI, you have to really run and you have to really walk at the same pace of other companies. If not, you are going to be alone and you are not going to grow the same as other companies. Pretty clear that Mobilize 3% in the red, data center 3% in the red, network 1% in the red, and what is in green is just single digits growth. I think it's pretty clear that we are not in a good situation with Intel. Now let's talk about the elephant in the room, the interest rates. How are we pricing in all this news, all this economic data that impacted us on Thursday and Friday? Pretty aggressive, 70%, 78% of the first rate cut in September, 75% in November, 66% in December. So markets have pretty clear that they are going to cut interest rates 3 times. Look at all these guys that are betting on 50% basis point. These are the guys that are freaking out with the aggressive cut from the Fed. And these are the guys that are causing a lot of volatility in the markets. It's not low probability. This is almost 30%. This 22 was almost 36 at some point on Friday. So certainly there are a lot of analysts, a lot of big money players, investors, banks, funds that are selling everything because they think we are in a recession. I think the situation right now is at the edge of the recession. We are going to see how we can interpret that. But basically what is happening is that a lot of people are calling for a not so soft landing. The market and the Fed wanted the labor market and the overall economy to cool down enough to bring inflation down, but at the same time, not enough to cause a recession. So far, the monetary policy has helped to do that, but yesterday's labor market data made investors feel the Fed made a misstep at Wednesday meeting. They thought that they were going to cut rates, and with this data, they are really thinking that they were wrong. They should have cut interest rates. Non-farm payrolls was one of the reasons, well below estimates, and more importantly, the unemployment rate peaked higher from 4.1 to 4.3. And there is something called the SAM rule, which if you take the 3-month average in a year, we are not going to calculate that, but you can see pretty clear that the 3-month average is going above the rest of the year. So the last 12 data points in terms of 3 months average are way higher than expected. So these guys, look at this step. These guys are the ones that are putting the pressure to the upside to the unemployment. And basically this SAM rule states that the economy is in recession when this happens. Recession fears is what we are talking about. The problem is that there are other areas of the economy that are still pushing higher. GDP is pushing higher. We have quarter growth estimates still above 2%. So it's technically impossible to have a recession when we have the economy growing, right? This is what we should be thinking, but the market is really freaking out with all these two data. With non-farm payrolls and employment rate at these rates, they think that we are not going to get the soft landing because the Fed was wrong not cutting rates. Corporate household balance sheets are in good shape. We have no systemic asset price bubble in place. Nvidia has corrected quite a lot. And also the Fed has the tools available to help increase growth. So the good economists, the economists that are thinking twice and are digesting this news, really say that the hard landing is not like that, still a possibility. So we have a slowdown occurring right now, and the pace of that slowdown has accelerated. We can see that on the Nasdaq daily chart. Let me just hide all this, because we started with this volatility and then this and then this. So we can see how in three steps, we have corrected more than 12%. So the possibility of a 50 basis points cut in September is widely viewed as possible if data continues to suggest that the Fed needs to make up for this week's misstep, but I don't think it's going to happen. Barkin was also saying that 50 basis points are reserved for things that need rapid response. And I don't think we are in a rapid response. Why? Let me explain you why I think this was something under regular circumstances. First of all, this is the continuous chart on the Nasdaq. And let me first explain you these head and shoulders that we were building all these months since June. So as you can see, there's a structure here on the daily chart, and we have this technical floor, the neckline. We have this neckline, which we already rejected, the same as the 20-day moving average. So from a technical standpoint, this is pretty clear that we were going to continue selling off because there's a lot of points in the economy that are weakening and the growth is slowing down and inflation is going down. So if growth is expected to slow down, the markets are going to price in these new prices. So first, these head and shoulders quite clear this rejection on the neckline and on the horizontal level. at 19,728, and the 20-day moving average now is resistance. Also, at that point, we had point of control up here, exercising a lot of pressure to the downside, and the point of control moved down to here, and we continuing selling off. So on the daily chart, it's true that we are, let me just go to the 4-hour, let's continue going down. It's true that we got this huge sell-off and head on shoulders. Since the right shoulder, we've been selling off pretty hard. On Friday, since Thursday to Friday, we sold off like, let me tell you, because it's quite unbelievable. From here to here, we sold off 1,300 points in 2 days. So this is big selling. This is not only a correction. This is most probably a change in sentiment and change in market structure, but we are not going to enter a recession for now. Key levels that were hit was this pivot at 18,500. That was quite psychological level. We went through that a little bit, but we managed to close at that specific level. More things that I would like to show you. On the 1 hour, we have this zone that I've been talking about all this week. This zone on the purple line, on purple box, we went down, we rejected, we skyrocketed higher, and we rejected basically the zone in which we got the daily 20 moving average here and the 45 and the horizontal neckline here and here. These two zones were rejected on the 1 hour, and after that rejection, when you try to break out and you enter again, it's time to just take everything out. And that's what happened. We just sold off directly, selling, and look at the volume. The volume was quite insane. Selling throughout 2 days straight. 2 days straight of volume. What do we have in terms of that, in terms of volume? So if we expand to have the entire range, we have the volume peak here from the box in the range and the point of control from all-time highs. So this is our new anchor for change of sentiment. Right now, we are not going to change anything below point of control. Is just shorts. I'm not going to short as much as I would like to buy the dip in other circumstances, but this is your time to short now. I think the correction is not over. Let me just remove this a little bit. If we hide the volume and we just try to see where are those levels, where might be those levels. We crossed the 10% from all-time highs here. We tapped the 12% at 18,500 and we managed to hold there. There's a possibility of a 15% correction and tap 17,700s. That would be in a week, another, we close at 500s. That would be for 50%, 3.62%, or 4.60 in the week. We can certainly do that. So I would be, my first analysis is, I think we are going to continue selling off, perhaps with some kind of structure like this, but we are going to continue selling off. But I think we have key structure here. We have 18,000, we have 17,800s for the 15%, and we have 17,700s for a key structure at the left. So In terms of that, also in terms of levels, I can also see, look at this, since the last pivot, this is the anchored VWAP, and we have the 200 moving average that was support last time. The anchor VWAP also took price the last time. We have the anchor VWAP at 18,200 and the 200 moving average at 18,150, right at these zones down here. And also a daily fair value gap. This is going to be my first sign of maybe we are finding some support. So this is this stair stepping up line. This is the 200 moving average on the daily here on the 4-hour. It's not the 4-hour 200-day moving average. It's the daily one being put in this time frame. So this level is 153. So I think 18,200 is going to happen sooner rather than later. So this is my first zone of support. I think we are going to continue selling off, rejecting the 12%. And for now, I would like to see the response, the price action structure at this level of 18,200. If we start to bounce, I'm not interested, because the last time we tried to bounce, we just fell off hard 1,300 points. So I'm not interested in any bounce without any big structure on a key level. That's my constraint for now until we see again the point of control. So the strategy says that any bounce from here is going to be met by sell demand, huge sell demand, and we need to have more structure with a lot of confluences. And I would like to see that confluence to be the daily fair value gap and this 18,209 and also the 200-day moving average. That's my first step, my first level of bullish sentiment. If we don't hold this, then I will update this strategy, I will update this setup, most probably to meet the 15% from all-time highs and 17,700 with this pivot down here. That would be number 2 setup. And I'm going to be patient. I'm going to see the price action. I'm not going to jump on everything on FOMO, because we are in an environment in which if you don't manage your risk, you are going to get demolished. It's as simple as that. We are in a situation in which you cannot buy the dip anymore blindly. You have to wait for structure. You have to wait for big fat levels, because then you will have the confidence that maybe other institutions, other people will join you. So as I said, that was my 2 setups for the Nasdaq. Why is this so important? Dollar, it's selling off due to a lot of weakness. We have the economy slowing down pretty heavily, and the dollar got 1% to the downside. Yields, look at this. Look at this. This is a big sell-off in the bonds market, in the short-term one, in the 2-year yield. This is pricing in aggressive interest rate cuts. But what about the long-term economy? The 10-year yield, it's also selling off. So this is pretty important, because these 2 yields are showing you aggressive interest rate cuts and recession fears, recession concerns. The inverted yield curve was up 46% on Friday. This is the biggest increase ever since, I would say, in October 2023, we got 44 reading, and yesterday's was pretty insane. And I told you, when I saw this, I told you, be careful. When I saw this, I told you, we are increasing our concerns. And look at where we are. We are at, right there. We are at an inversion, almost. We are there. And when this thing uninverts, we are going to freak out even more because something is broken and we need the Fed to support the market. This is what it's all about. Treasuries were skyrocketing because this is on the other direction. Treasuries think that yields are already topped and treasury bonds are going to skyrocket because there will be no more yields and the price is inverted with the yield. So if the yields are going down, the price are going higher and the price is skyrocketing. Everyone's going into treasuries as a safe haven. Gold is being sustained more or less a little bit, but I think it is what it is. I'm not going to review every individual tech stock on the Magnificent Seven. I'm just going to tell you the economy is pricing in a hard landing and a recession. Maybe I think we overdid a lot. Actually, let me just show you real quick my trades. This trade, same setup as always, bullish fair value gap into the inverse. I took it. We got a pivot. I put my stop at break even, not break even, at this pivot, and I got stopped out for, let me just tell you, it was 10 points, 13 points. Look at this chop, pretty difficult price action. Then NFP candle, huge NFP candle, but look at this. We tapped this and I tried to long that on the feed retracement because this move was quite clear. So I tried to tap, it tapped the fair value gap. I was watching the fib retracement, the golden pocket for this range. We got a little bit of a move and I got stopped out for 30 points. So I took it in other trade. I don't think so, right? Yeah. I was down on Friday, like $300. It is what it is. The volatility is insane. Insane. There was this was the 12% zone that everyone was trying to buy, as you can see. But I think this is going to fall. And we are going to revisit the next level. The next level. This is the volume peak of the range. As you can see on the other chart on the NQ. Let's just go to the NQ. On the continuous chart, you can see how oh, I remove it. Yes. Go real quick to that. Sorry about that. Need the okay, so here it is. I think we are not going to stop here at the 12%. I think there's more to come down here. The 200 moving average is going to support a lot of that. The gray area is the daily support, the daily fair value gap, sorry. And I will watch that. But until then, I'm going to watch. Because this is not only a pullback. It started like a pretty aggressive pullback, but that was at July 11th. We are in August 3rd, almost 1 month ago, and we've come down 12%. This is crazy. This is already what we were concerned about. Dollar weakening, yields going down, the inverted yield curve uninverting. We have data showing you that the slowdown is happening. A lot of people is freaking out and pricing in aggressive rate cuts. But calm down. Calm down. Let's see what happens next week. Next week is going to be key for patience and discipline. If you take some trades, just manage your risk to the extreme. Don't let them run. Profit is profit. Because if you are short, If you are still trying to short this market, you may have big time problems if the market decides to turn back. And if you are long, you have to really nail down your supports, your key levels. I already told you my key levels. I have two setups. The first setup is basically to support on the 12% or to break down the 12% into the 18,200s for the daily moving average, the pivot blue, and the daily fair value gap in here. And the second one is continue rejecting that into the 50%, 17,700s into the daily pivot, which is below that. We are starting to destroy the Nasdaq, and I don't know what would happen. But it is what it is. This is my thoughts. As always, if you found this video useful, please give it a like, subscribe to the channel. I upload videos like this one, like this weekly recap every single Saturday for you to review with me what happened on the economic front, on the technical analysis, in other markets, news, earnings. I do this not only for me, also for you. These are market charts. I trade with these levels. I trade with these charts. And it's quite important for you to understand what is happening. I tried to basically explain you how this market is behaving, and it's quite scared right now. We are in fear, and when everyone's in fear, you have to really take a step back and see what can we do, where are the key levels, and just follow your experience, follow your process and your strategy, because at some point we will find buyers, and we have to really be cautious, but we have to not be feared of taking action. This structure is decent. We are holding the 12%. If this holds, good. Let's see if we can have some structure. But if not, we have also a plan to trade the downside and also wait for new levels below. So pretty important week ahead. Patience, discipline, risk management, more than ever. This is the key month of the year, August. After a decent July and pretty big upside on the year to date, August is going to be key to really break, really see if we are going to sell off the rest of the year with the uncertainty on the election, with the uncertainty on the rates. In September, August is going to be pretty insane to trade. So take that in mind. This is going to be difficult, but just do your own work, do your own analysis, get your confidence, follow your process, refine your strategy for a volatility like this, and let's get it done. Don't be fearless these markets, because you will be surprised how resilient these markets are. When they want something, they take it, even if it's to the downside or to the upside. To the downside, I think we got a lot of things. Look at this sell-off in 2 days. Look at this sell-off in 1 month. But at some point, big players will just step in and try to support the economy or try to take positions long term. Because long term also exists. Remember, this is not only day trading. We are at a level of interest. We have another level of interest down here with the 200 moving average, which is huge for the daily and weekly time frames. Those have big pockets. So don't think only with your brain of day trading or swing trading. Think about that people that want the Nasdaq at good levels, that want Nvidia at 100, that want Apple at 200. They will invest all time. So you have to be patient for them to step in take your levels, follow your strategy, take your setups, and then that is called trading. Don't FOMO, don't YOLO, just be patient. Follow your levels, your technical analysis. Right here, we have a huge range, which I'm interested in, but we are in the middle. So I have to exercise patience for the price to go down with me and things like that. So that's all. Stay safe, everyone. Have a nice weekend and see you on Monday.